So good afternoon and welcome to our webinar today, How the Digital Asset Landscape is Evolving. My name is David Dalton and I lead Deloitte's Financial Services practice in Ireland and also lead our EMEA Blockchain Lab, which is based in Dublin as well. The focus of this afternoon's webinar is on digital assets, and while the cryptocurrency space has been enjoying a recent resurgence, for those of us who've been working in the blockchain space for many years, digital assets have long held a promise not just to digitize currency and payments, but also to transform other parts of the global financial system. In today's webinar, Lisa Simpson, who leads part of our blockchain lab in Dublin, will lead a panel discussion with 4 leading subject matter experts to examine this topic from a regulatory, from a strategic, from a tax and investor perspective. There will be an opportunity for those of you in the audience to pose questions to the panel as well through the Q&A box. Just flag that at this point. Before that, Jack Lee, a director who leads our digital asset team, will provide an overview of the digital asset environment, some of the key trends we see, and key developments. I think this is a really interesting topic, and I'm sure you're going to enjoy the discussion. And with that, I'm going to hand over.
Thanks, David. Welcome everyone today to today's webinar on digital assets. Today I'm going to give you a high-level overview of the current market trends, the types of digital assets, and the opportunities specifically for the asset management industry. As Dave mentioned, my name is Jack Lee and I'm a director in our audit assurance practice leading out on investment management and the digital assets. As David noted, there's been a significant market activity in digital assets in 2020, and this trend has continued into 2021, which illustrates the growing demand for digital assets. If we look back to 2009, when Bitcoin first came about, it was a digital asset that had very little value. In 2013, the overall market cap of Bitcoin reached $10.5 billion. In 2015, we had the launch of Ether and some other alternative coins, which increased the market cap of digital assets to $17.8 billion in 2016. In the last 4 years, we've seen the market cap of digital assets reach over 1.1 trillion at its peak in 2021. And this is a phenomenal increase in the market cap in just over 4 years. We've seen the introduction of stablecoins in early 2014, but the value of stablecoins has only really had an impact on the market cap since 2018. As of lunchtime today, the overall market cap of digital assets was 1.06 trillion, but given the market volatility, this continues to change. Stablecoins have become really popular in the last few years for some of the following reasons. From a commerce and a payments perspective, some businesses are now accepting fiat and stablecoins to avoid the volatility that traditional cryptocurrencies have. Specifically on the 5th of January this year, the Office of the Comptroller of Currency in the US, the OCC, approved the use of stablecoins for settlement of financial transactions by banks, which further accelerates the growth in digital assets. This is a huge boost for stablecoins, and other payment platforms are currently considering stablecoins as a payment option. Stablecoins also enable the exposure to fiat rates, an easy conversion to other cryptocurrencies, because a number of them are already pegged to certain cryptocurrencies, a lot of them pegged to Bitcoin. Stablecoins can also be used as a means to store value, and again, as mentioned, are less volatile compared to traditional cryptocurrencies. I suppose the key thing to take away from this slide is that the market cap of digital assets has significantly grown in the last 4 years to over 1.1 trillion at its peak. But the market is quite volatile, and there are new coins like stablecoins becoming much more popular as a payment option going forward. So let's now touch on, so we kind of talked about stablecoins, but what exactly are they? And what are the other types of digital assets that actually exist in the market? So while digital assets are most commonly associated with cryptocurrencies such as Bitcoin and Ether, digital assets are much more diverse and can be used for a variety of purposes. We define a digital asset as something that's represented in a digital form that has intrinsic or acquired value. A digital asset is designed to work as a medium of exchange that uses strong cryptography to secure financial transactions, control the creation of additional units, and verify the transfer of assets. In recent years, digital assets has come to include assets that are represented on a blockchain or a blockchain-like network. Aside from cryptocurrencies, other examples of digital assets include utility tokens, which are assets that people can buy with the intention to use for something in the future. A good example of this is where a company develops an online gaming and they could use utility tokens to actually fund the development of the game. There are also other types of digital assets, which are specific asset-backed ones, which are represented by, for example, land, commodity, and property, or general-backed asset tokens or fiat currency-backed tokens, which are considered stablecoins. Stablecoins are cryptocurrencies designed to minimize the volatility of the price of a stable coin relative to a stable asset or a basket of assets. So a really good example of this is a US dollar-backed token. And there are companies like Tether out there that have issued a number of US dollar-backed tokens. A stablecoin can be pegged to a cryptocurrency, fiat money, or an exchange-traded commodity like a precious metal. And I suppose as we move forward into the future, we will look to see other assets getting tokenized like debt, equity, and other financial instruments and beyond. As more and more types of digital assets appear, we're seeing the regulators and the central banks now start to look at central bank digital currencies, or CBDCs, which is a digital form of fiat currency serving as both a medium of exchange and a store of value. More specifically, CBDCs is the central bank's liability denominated in a unit of account that can be held and transferred electronically by the general public. Like cash, it earns no interest, it's uniquely identifiable and universally accessible. In economic terms, CBDCs is the equivalent to cash. The most interesting thing at this point is there are about 70% of central banks exploring the use of CBDCs, and there are a number of jurisdictions that actually are doing proof of concepts and pilots. And most notably, these are Sweden, Singapore, Hong Kong, Korea, China, and the Middle East. The race to CBDC adoption will accelerate the adoption of digital assets and actually will allow central banks to focus more on the regulation of the different types of assets. So the really key thing to remember here is a digital asset is an asset in a digital form. There are many different types of digital assets, from our traditional cryptos to asset backs to tokenized debt and equity. So there are, and then this particular space will increase as we move into the future. In terms of digital assets themselves, there are currently over 8,800 or 8,280 different types of digital assets being traded, and this has been noted on CoinMarketCap. And they're currently being traded over 290 exchanges. The average daily volume of the top 10 exchanges is currently about 27 billion. And the exchanges and other providers are also providing other services in derivative cryptocurrencies, lending, and staking, which is enabling liquidity in new markets. Staking has become a very popular concept given the high costs related to mining of digital assets. And staking is the process of actively participating in a transaction validation similar to mining on a proof of stake. Anyone with a minimum required balance of a specific cryptocurrency can validate transactions and earn staking rewards, and this has been a huge source of revenue for a number of exchanges. Assets in crypto products has increased sixfold in 2020 from 470 million to 3.3 billion, according to Morningstar. Digital assets offer users many benefits, including tokenized physical asset facilities, allowing for easier and more frictionless trading on secondary markets. They provide a heightened degree of historical transparency, a record of provenance, and because digital assets allow for larger, more indivisible assets to become divisible, they can help create more inclusive, accessible trading ecosystems for institutional and retail investors. Therefore, it's actually no surprise from our Deloitte annual Global Blockchain Survey 2020, a lot of our respondents viewed digital assets as actually quite favorable. Nearly 89% believe that digital assets would be important to their industry in the next 3 years. And an even more important statistic was that 83% believed that digital assets would serve as an alternative to or outright replace fiat currency in the next 5 to 10 years. If we move to a regulatory perspective and specifically focus in on Europe, we've seen huge developments in this space in trying to regulate digital assets. Almost 2 years after the European Commission adopted its FinTech Action Plan, the European Commission did, in September of 2020 this year, propose its future EU framework for market and crypto assets, or the MiCA framework. The EU has recognized the inherent interests in promoting crypto assets, and the universal benefits of crypto assets include the ease and integration of payments for users, as well as increased access to financial markets for consumers. The Commission did recognise the lack of harmonisation among EU member states in crypto asset regulation, and actually noted that a large portion of crypto assets actually fell outside the EU regulation as well. So the proposed regulation on MiCA is aiming to provide an EU harmonised framework for the issuance and provision of services related to crypto assets, exchanges and trading platforms, while mitigating the investor risk and addressing financial stability and monetary policy risk. This regime is aimed at contemplating the current framework, for example, if complementing the existing the current frameworks. For example, if existing frameworks do not yet address any of the digital asset categories, or there are new regulated entities that are set up. I suppose if we look to current regulation, which actually is in place around digital assets, we do have the Anti-Money Laundering Directive 5, or AMLD 5, which came into effect on the 9th of July 2018 and was mandated to be transposed into domestic law in EU member states on the 10th of January 2020. AMLD 5 brings custodian wallet providers and digital asset exchanges into the scope of AML, where these entities need to have appropriate AML policies and procedures in place. In addition, some of these providers would have been required to have an e-money license to operate in the EU, given that they were dealing with fiat currency for investors, which means they may have already had AML policies and procedures in place. The other type of regulation that can capture digital assets from a European perspective is MiFID II. So under MiFID II, potentially some digital assets are classified as financial instruments and may have reporting requirements under MiFID reporting. I suppose the key thing to note here is that digital assets will be important to businesses in the next 3 years, and therefore existing regulation that captures AML. There are existing regulations that capture AML, but the new framework will hopefully harmonise the lack of consistency across the EU. So I suppose let's turn to the ecosystem for digital assets. You might think that the ecosystem is actually very different to a traditional fund ecosystem, but what you'll actually find is there are a lot of similarities. For example, we have in the ecosystem, you do have investors, you do have a fund or a product that sells digital assets, you have a custodian that custodies digital assets, and an asset manager that actually executes the trading strategy. I suppose a number of things that are slightly different or unusual are we've got enablers within the ecosystem. These are the miners, node operators, and validators. And these are the participants that actually create new digital assets, allow people to access and validate transactions on the protocols, on the protocol platforms. We also have the public versus private protocols for digital assets. So in some cases, you've got digital assets which are decentralized and sit on a public infrastructure, and then you have some that are on private infrastructure, where only certain participants are actually allowed to trade in those digital assets. And I suppose from a private infrastructure perspective, it is very similar to trading in private equity investments, where only a certain amount of people actually have access to transact in those types of digital assets. One of the really important terms that is come out of the digital asset space is DeFi, and it's an important term as it's short for decentralized finance. And it's an umbrella term for a variety of financial applications in cryptocurrency or blockchain geared towards disrupting financial intermediaries. DeFi draws on the inspiration from blockchain, which allows several entities to hold a copy of a history of transactions, meaning it's not controlled by a single central source. Digital assets stand out from legacy payment providers, given that they actually remove the middleman from the transaction. And this is only one example of the use of DeFi. Other use cases of DeFi are decentralized exchanges, stablecoins, and lending platforms. And again, I suppose the one thing to sort of take away from this is that there will actually be huge investment requirements into new technology in order to be able to service digital assets. And one of the reasons being is that the underlying technology and platforms are vastly different to the traditional investment fund platforms. So there will be some investment required from organizations going forward. So what are the opportunities for the asset management industry itself? Let's look at it from a couple of different perspectives. From a trading perspective, the most common use strategy in digital assets is algorithm trading. And given that markets don't close, algorithm traders can actually take significant advantage in relation to the volatility of some of the digital assets. The speed at which transactions can settle is another key benefit, as traditional trading in stocks and shares does require a 1 to 2 day settlement before investments can actually be brought into custody, whereas with digital assets, they settle instantly. From a custody perspective, as digital assets become more mainstream, traditional banks and custodians will all look to have a digital asset arm to their business. The market is currently being disrupted by some of the exchanges who are setting up their own custody practices. And as more assets like traditional stocks and debt get tokenized, this will be a really important part to a custodian's business model in order for them to be sustainable. In addition, as discussed earlier, given that the settlement happens straight away, there is an opportunity to do lending or staking, which will generate additional revenue for the business. From an asset servicing perspective, if more funds start to trade in digital asset servicers will need to have the infrastructure to support their clients. They can do this by supporting clients in the issuance of tokens, like tokenizing real assets like land, property, commodities, etc. If we look at it from a funds perspective, asset managers can use digital assets in different ways across their strategy. They may consider diversifying the risk of their portfolio, and maybe for the time being, digital assets could present higher yields or higher returns, or they may invest into more stable assets like stablecoins or CBDCs, which are less volatile and can obviously earn a steady return for their investors. The asset managers can also use the digital assets as a method of hedging for some of the risk profiles, or they can create liquidity in the market where traditional assets liquidity was actually not easily accessible. A really good example of this is around real estate, and only certain institutional investors may have got access to real estate. I suppose the key thing to note overall is that digital assets is continuing to grow at a rapid pace, and all areas of asset management sector will need to consider the business model and how they can implement digital assets into their strategy. I know actually there's a lot of information to take in, but hopefully I've given you a good insight into some of the current market trends, the opportunities for the asset management industry in relation to digital assets. Digital assets are going to be a major asset class in the future, and it's now time for organizations to start considering their business models to ensure that they're prepared for when digital assets become mainstream. Thank you all for listening. I'm now going to hand you over to Lisa, who's going to moderate our panel discussion and do a deeper dive into some of the areas which I touched upon as part of this presentation. I'm really looking forward to hearing from our panel of experts and their experience with digital assets. Over to you, Lisa.
That's great. Thanks so much, Jack. And thanks for providing us such a good kind of grounding and overview of the digital asset landscape, particularly around the trends, where we're headed, some of the regulatory response and some of the opportunities. So definitely looking forward to diving a little bit deeper into some of these insights and getting some more perspectives from our esteemed panel of industry experts. So before we do that, I should introduce myself and who's joining me today. So my name is Lisa Simpson. I'm a senior manager in our EMEA blockchain lab based out of Dublin. I've got a great panel for us today. So joining me is Rob Massey. Rob is our global tax lead for blockchain and digital assets. Rob has been working in the digital asset space for over 8 years, mainly supporting clients from a tax perspective, so we're delighted to have him here. Next up, we've got Luke Sully. Luke is the CEO of Custody Digital Group. It's an Irish registered digital asset platform for institutions and enterprises. Luke has been actively involved in this digital asset and blockchain space since 2013, so thank you for joining us, Luke. We also have Adrian Benedict. Adrian holds the role of Head of Real Estate Solutions at Fidelity International. Adrian's responsible for capital markets, fund structuring, and bespoke client solutions. So great to have his perspective on board also. And finally, we've got Marco Grossi. He's the CEO of Atomize by Token Trust. Marco has more than 17 years of experience within the financial service space and has been heavily active in the distributed ledger technology space for the last number of years. So a great panel. Thank you all so much for joining us here today, and looking forward to digging into some of the insights that Jack had provided an overview of. So let's do that right now. So starting off, I think the first thing I want to touch on really is Jack's opening slide around some of the trends we're seeing in the marketplace. A huge amount of growth, volatility, particularly over the last number of weeks, even in cryptocurrency and blockchain and Bitcoin particularly. So Rob, coming to you first, you've been in this space for over 8 years, kind of interested to get your perspective. What are we seeing? There's different types of cryptocurrencies, stablecoins, so forth. So it'd be great to get an overview of kind of giving us a grounding on what they are. And then what are you seeing? Like what type of adoption and why are we seeing such growth happening right now?
Yeah, absolutely, Lisa. And I think, to your question, stablecoins, I think we got that in the chat as well. The inspiration behind stablecoins, I think, is actually driven a lot by the investment management and asset management industry, particularly those who are trading frequently. It is clunky and sometimes takes a lot of time to convert from digital assets to fiat currency, and particularly those who've set up algo trading platforms. You want to exit and enter positions very, very quickly. So the stablecoin, a lot of it was inspired by getting into something which is stable, and that is frequently a digital representation of a dollar, such that you can enter and exit positions, getting back into your native fiat currency with, but using a token representing that fiat currency versus getting all the way back to fiat in its entirety. So that's been a lot of the use, but it's really, people like to use digital assets as a method of payment, and without the volatility risk all the time. So, and that's a lot of what's inspired CBDCs in the future, as Jack alluded to. But the real growth in the industry, I mean, we're really seeing it just mature across many different elements of the ecosystem. I think in particular, we've seen investment in trading in digital assets for many, many years. But particularly in the last year, many more sort of brand names engaging in this space. Traditional asset managers wanting to have positions in digital assets. Their investor base, their customers really want access to those. And so, with that increased demand and limited supply, then we're really seeing just a lot of attention here. In addition, it's corporates really leaning in, thinking that it's nice to have some exposure on their balance sheets. Those who have excess cash, looking at that as a means of investment. We're looking at it across pensions, significant increase in family office activity. And then importantly, it's the infrastructure players. It is payment processors, traditional payment processors, giving access to hundreds of millions of users already signed up to their platforms now, saying, hey, you can work in fiat or you can work in crypto. And lastly, banks. And I'd say the engagement of banks and large FIs is definitely to engage in digital assets now and cryptocurrencies, but it is really just the first step. The engagement in digital assets now enables them to reconfigure how they work and all of their systems from a technology standpoint and a regulatory standpoint. To engage in the digital assets of today allows them to engage in digital assets in the evolution. Because even if you said, I'm not a super believer in the cryptocurrencies of today, which is fine, you would say, gosh, this is probably a step in the journey, which will lend to more and more engagement of digital assets in the future, notably CBDCs. And it's so complicated for banks to transform in a manner, again, technologically and from a regulatory standpoint to engage. Why not do that now so that you're ready to engage in the future? So really across all segments of the ecosystem.
Investors who are coming into this space as well. So kind of sticking in that point, Luke, coming to you, you spend a lot of time with institutions and enterprises in the digital asset space. What type of investment is happening here? Enterprises are getting into the market. Luke, can you hear me?
I can, yeah. Your question was a little muffled, so I will. I don't know if you could repeat that real quick, or I could have a stab at trying to answer off the back of Rob. So I think what we're seeing in terms of an investment thesis. Look, I think I think it should be no surprise to people that there's a sort of buy and hold strategy with Bitcoin. People are long Bitcoin, and that's really driven by two primary investment theses, which Jack had alluded to, which is this notion of Bitcoin as a digital gold equivalent, but also as a hedge against inflation as well. So I think that's sort of driving some of the investment thesis. Predominantly, we're seeing a lot of arm's length passive investment as well through ETF or ETF-like structures that are popping up here in Europe. I don't believe ETFs are yet approved in the US, but there's a notion of creating a passive arm's length access to the asset class. In terms of what's really of interest to us is cryptocurrencies on the balance sheet, and we think that there's something like only 5% currently of all mined Bitcoin sit within corporate treasuries. So there's still, I think, some reluctance from corporates and institutions to hold it, and that's driving some of the use cases around that passive access to the asset class. And then I think the last observation I would make is that I have heard, and I think it's quite interesting that some investors view BTC as a tech stock rather than an investment, rather than an asset class, and I thought that was an interesting way of potentially viewing your involvement in the industry as well.
That's great. Thanks so much, Luke. Marco, interested coming to you now. I mean, there's more opportunities in the digital asset landscape beyond just direct investment. What type of opportunities are you seeing?
Thank you, Lisa, for the question. Yes, we see three main pillars where we use digital assets. One is a business case where we can create new investment opportunities around old world and new world. Then I also see another possibility by improving existing operations within the financial world. T+0 was already mentioned. Reducing of counterparty risk is another one, and reducing costs by avoiding some intermediaries that can be used in the old world, but in a new world, the digital world, you don't need them anymore. And a third piece, which is very strong, where I'm on, is improving of the supply chain, especially in the commodity business, where we are working on, where you can combine the industrial and the investment work together, creating new asset allocation. One example here, if you today are in the battery industry, you have certain metals that you need to use, so you can think about either you invest into a share, into a bond of a company that is using these batteries for its business, or you go back and say, may I invest into the commodities that made up this battery? And if you digitize these possibilities, these commodities, you create something new that maybe before wasn't possible to do.
That's great. Thanks, Marco. Lots of really interesting opportunities happening there. I've turned up my camera, so hopefully that helps somewhat. Adrian, Marco's spoken about a lot of opportunities that we're seeing, right? And a lot of exciting kind of trends happening. Kind of want to take it to where we are today, right? So much has happened in the last 12 months. There's been so much change and disruption. COVID-19 has us all working remotely, and me with my audio issues as a result. Just wondering, do you think the market is now ripe for disruption like digital assets, and is now the time that we're going to see big growth in this space?
It was my turn to talk without having pressed the button, wasn't it? Somebody had to do it. It was sod's law, it was me. I think COVID-19. Who knows exactly? We'll be writing in the history books in a few years' time. But I'm pretty confident one of the things will be, as you alluded to, a significant ramp up in the interest around digital assets, but also more broadly about actually what else it's enabled. And really, that's where I'm coming from, because COVID-19 it has shown actually what the true nature of what disruption can be, and the pace and the breadth of disruption. In the past, we would always talk about disruption in the abstract. Oh, there's this bit of disruptive things, and it's going to be positive disruption. Now we actually know not all disruption is positive. But one thing which we've all learned is how quickly we as either individuals, companies, businesses, societies need to actually be able to operate quite differently, and how rapidly we need to be able to respond. And for me, I think that's really the biggest change that's really going to be triggered by the COVID-19. So for us as a business, all of a sudden our clients were naturally wanting to understand, well, what are the implications of this? Where is the evidence of that? And how can you go about predicting that? Now, those businesses had started to make that migration from Excel spreadsheets to systemized ways of dealing with these things. Great, we were okay, but even then we saw the limitations of that. So for me, when I look at what digital assets really opens up, yes, we've talked about things like tokenization, but what we've not really talked about is actually the infrastructure that's required to power all of this up. And really what's at the heart of all of that is data. And being able to make informed decisions with that and linking that through, whether it's through transactions and other things. So as I said, I think we will be looking back on 2020 as being a year where this really has started to go into mainstream, but beyond just simply recognizing this as an asset, but actually increasingly as being an enabler for so many other things. So I'd like to leave the audience as one thing. It's yes, we might be inventing a new form of currency or cash, but what does cash enable society to have done? Everything that we see around us. Well, that's the bit which I'm really interested in. What can digital assets actually enable more broadly? That's
great. Thanks, Adrian. And very kind of a positive outlook there in terms of where we think we could be heading. Wanted to touch maybe a bit on the challenges, right? Because digital assets, we're not going to see mainstream adoption overnight, and there are some challenges and barriers to mainstream adoption. So I wanted to touch kind of briefly on that. Maybe coming to you first, Luke, KYC in particular is a big challenge. And I know 2020 saw an acceleration in the type of verification of digital identity that digital asset service providers need to provide. Wondering from your perspective, enterprises trying to get into this space, what kind of impact is KYC regulation having on them?
Well, so I think a few observations really. I think there's a lot of KYC in being conducted constantly by entities in the digital asset space, and that is set to increase, particularly now with the travel rule, which is coming into effect, which pushes identity information into transactions across the blockchain. I think the other trend we're seeing is the sort of a bifurcation of the world between hosted wallets and unhosted wallets. Hosted wallets being those that are provided by an entity which has conducted KYC and has a real world identity behind the owner and operator of the wallet. I think the impact of this entire debate is quite mixed right now. I think institutions want the same level of assurances when they operate in the space that they're not doing business with a terrorist financing organization or a terrorist organization or a bad actor. But I think conversely, they should also have some reasonable expectation of privacy in their business and their operations as well, just as they do in some of the mainstream markets and financial services. So, I think that sort of encapsulates between this debate that's going on right now between privacy and anonymity. And I think that really is an issue that it isn't quite well understood. I think we want to stamp out anonymity, but we should also expect some privacy as well. And I think finding that balance is we're seeing that real time with regulators around the world. And I think my last observation, just real quick, is that when you're talking about mapping identities, we're not just talking about humans. There are a lot of business models that require access. The access is made through devices, applications, machine agents, particularly in the algorithmic trading space. And so when you talk about KYC, we have to have a much more holistic approach to those technology sets that interact with the system, and ensuring that there is actually a real world identity behind that as well. And that does tend to get lost because we assume it's a very like-for-like comparison with the mainstream world. And I think that also, if you can start to solve the KYC problem around those issues, you start to see the level of KYC improve and increase, and that just adds more reassurances for market.
Yeah, no, makes total sense. Great observations. Thanks, Luke. And kind of sticking on the topic, I guess, of some of the challenges, and coming to you, Rob, maybe from a tax perspective. Maybe not a lot of people think of what their tax liabilities may be, and maybe depend on the jurisdiction they're in. Kind of keen to get your perspectives and share your insights on this landscape.
Sure. Thanks, Lisa. And I think, many of us are used to the fact that different countries around the world have different points of view about taxation and just in general. But as we've come into this industry, I'd say, the pace of adoption in every country is a little bit different. And while some of the concepts repeat and are interpreted similarly, there's a lot of differentiation in how different jurisdictions are thinking about the different asset types, which we've referenced, but also the types of activities. Remember, it's not just trading digital assets, investing digital assets, but the new product forms, like DeFi is arguably a new way to engage in digital asset returns. There's the concept of mining, which we've had for a while, and then that's evolved into staking assets, which are very popular today. And so it's not just the types of digital assets, there's different points of view, but the activities. And so, and the pace continues to evolve at a pretty rapid pace. And I'd say the regulatory environment is not quite there, and so there's a lot left to interpret. It's a time for companies engaged in this space, investors, but also advisors, to really be thoughtful, exercise high levels of care. There is a lot of analogies being made to other business models, and just knowing that those analogies may or may not work. It's just a time to be thoughtful, engage with the regulators to the extent that they'll allow it, and try and get to the right answer. Back to Jack's slides earlier, these assets are worth a lot more today than they were a decade ago. And so, the stakes are high, pun intended, and we need to just make sure we get it right. Things like, basis tracking when you're dealing in fungible assets that are not always securities. How does that work? And making sure that you're actually identifying thoughtfully which assets you've bought or sold, some which have presumably very low basis, some with high basis. The concept of where a digital asset is deemed to exist, or where the activities associated with that are deemed to exist, draws into question things like effectively connected income to different jurisdictions. We aren't always afforded the same safe harbors we've been allowed with traditional asset investment types. As some have mentioned, the actions of the humans, but also the machines, are influencing this space. And so how does that impact the sourcing of revenues, as well as sometimes the character? So a lot of questions. I'd say the engagement is high among advisors, so that's great news. And there are bits of clarity throughout the world, but I would say it's a time to really be thoughtful and make sure you get it right, and be ready for debate if it's a gray area.
That's great, and it's promising to hear that there is so much engagement in this space, and we're trying to move it forward. And Marco, I might come to you from kind of a broader regulatory perspective, particularly in Europe. Jack mentioned that MiCA regulation is coming in to try and, I guess, standardize or create some cohesiveness across the European space. What have you been seeing, in terms of European regulatory response?
Thank you, Lisa. I'm specifically in Switzerland, so we have two things to consider: Switzerland and Europe. And as Rob already said, every country, every jurisdiction will have other interpretation in a couple of points that are important for a company. And as said by Rob, product, technology, also here on technology, a decision either to go private chain or public will trigger certain complexities. Then beside that, the decision on services that you will have in your country compared to other, and I'm speaking out cross-border issues, they remain also under a digital world. So certain things will not disappear, like KYC mentioned by Luke. country approach and a clientele as well. Not every country has the same interpretation of what professional client might be or is. In Switzerland, for example, we have an addition institutional client with professional treasury, which is unique. So I need to deal with a lot of different interpretation on various key points of the business. A positive movement we can see in the DLT laws. So there is a Europe moving into a technology interpretation of a ledger of a digital ledger. Switzerland as well anticipated even the implementation of it now in February, with the second portion coming late September. So we were really caught by surprise. So we were anticipating Q3. We need to move towards there, and suddenly it's already here. So positive, but also complexity, because we then need to change our business model to anticipate certain things to be on the market. Other things, as I said, they remain, so they will not be cancelled, like cross-border, like KYC, like IML, like monitoring. But DLT might facilitate that. So there might be possibility to use DLT in those areas to facilitate, improve certain processes. Again, here, always thinking positive. There is also a development in tax, as Rob mentioned. At least here in Switzerland, there are clearer views on certain things. It's not fully final view, but at least a clearer view than we had 2 or 3 years ago, which means the barrier to enter for an investor goes lower. He knows how to book things. He knows what the tax consequences might be. So it's visible. It's no more big question mark like it was a couple of years ago. And the last piece, which is also important also in our space, the old world and the new world is merging. We're creating new asset class. And again, here, and it goes into nitty-gritty. ISIN number, very important topic. Some of the companies can only invest if there is an ISIN number. So how gets such an ISIN number? And also here there is a move into creating new asset classes around tokenized assets, create unique identifier to move along the different systems, and also to create an easier onboarding for certain products, depending on the characteristics.
Okay, so it sounds there's a lot happening, and I think the perspective I'm taking away between KYC, tax, and wider regulatory is that it is moving in the right direction, and so while it's currently still a bit of a barrier and a challenge, moves are being made to kind of surpass that, which is positive news. And so on that front, I guess, Adrian, coming to you. We're seeing movement in the space. You spoke earlier about, now being kind of the right time for digital assets and organizations to get into that space. How do they get prepared? Jack mentioned in his POV, you may have to make some technology investments. Just kind of wondering from your perspective, how do organizations prepare themselves and what capabilities do they need to build to start addressing this disruption?
Sure, because I can appreciate, it's almost, where do you start? It's always that first step on the journey where almost you point yourself in the direction. And I think here you almost need to be prepared to go back on yourself and have somewhat a less than straight line towards your journey, because it is going to be hugely iterative. But the important thing is actually starting. So what we have been doing as a business is actually just experimenting. Prior to about 2 years ago, I had no idea what sandbox meant beyond simply what my kids might play in. Now it's everything that dominates all of our thinking. It's basically a place that you can play safely, and particularly for all of those on this call in the audience, we work within a heavily regulated environment, and we need to recognize that. So the question is actually, well, what are the moves that we can make? What are the benefits? And it's really about understanding where are the biggest benefits. And quite often that is so far removed from the front of the office where a lot of our executive time and energy is spent. It's actually really understanding how some of those benefits can actually be extracted already from what we do. And then all of a sudden you start to recognize actually what is the infrastructure that we need to be able to put in place to be able to then generate some of these longer term, perhaps more eye-grabbing opportunities. I think the other thing it's worth reflecting on is for the last, since 2011, we've just been running the biggest financial experiment the world has ever seen, at least in modern times. We've seen central banks basically saying, can we just inject liquidity to get us out of trouble? Now that firepower is pretty much not far off an end. It's clearly brought a lot of benefit, but also a lot of volatility. Asset prices are all-time high. Why? Because that capital has had to flow in a certain way. And that capital has had to flow in a certain way because that's actually been the most efficient way for that capital. But it actually missed some of its primary objective, which is actually to resuscitate the economy, to bringing back a more diversified and broadened sense of growth for society. Where digital assets actually comes into play is actually saying, well, can we actually address some of the inefficiencies and some of those obstacles for the flow of capital? And that, I think, for me, is really where asset management really can sit. We are custodians of capital. There are very pressing needs for that capital where there is also a consequent return that can be achieved. Can we use this technology then to actually plug those two together? And that for me then as a result means we're actually broadening a universe that quite frankly was untouchable. It's actually realizing then actually what the true scope of some of this technology is in terms of being able to channel capital in very different ways. And then the last point I just add is, I was just thinking about it on my rare trip to the supermarket. We're only allowed out once a week these days with COVID restrictions. People talk about provenance of food. My kids always talk about, well, where's this come from, and how much CO2 has been used to transport asparagus or whatever it might be. Investors are increasingly asking for provenance when it comes to their exposure on their investment books. How are we as managers going to deliver that? So we can't ignore what's actually already happening, but not happening in the financial world. Clients, investors, public, you're used to a certain level of experience, and financial services needs to deliver that. And I think now, through some of the technology that's available, that is now finally actually possible, albeit we're going to start with baby steps. So we all need to start doing those baby steps, and soon we'll be walking.
Sounds good. Thanks so much, Adrian. I'm kind of conscious of time. I'm sure we've got a lot in the Q&A box as well that we're going to want to get to. So before I wrap up this portion of the conversation, kind of interested to ask you all kind of one parting thought from me anyway, in terms of a lot's happened over the last 12 months. Looking forward, what are you all most excited about in the digital asset space, or the opportunities it's going to bring? So Rob, maybe to you first. What excites you the most?
Yeah, I go back to a comment earlier about the banks and the large FIs engaging. I think the level of interest and engagement and the degree of seriousness they're taking it means that it's we've matured to a level that this is definitely the first step in a journey that is clearly transformative to financial services, and I'm just really interested to see where the digital asset journey takes us. But I think the big takeaway for me is we are on the journey. The naysayers have calmed sufficiently just because we have so many segments of the ecosystem engaged. So it's just nice to have a better level of calmness in that everybody says, yeah, this is a real thing now, but it's truly the FI's engagement that have really helped say this is now real. Let's engage thoughtfully.
That's awesome. Luke, coming to you, what excites you most about this space?
Yeah, I know, Lisa, you've been pushing me to come up with a price for Bitcoin by the end of the year, but I will resist trying to put a number on it. I think for me, we're looking to see an increase in the user base and a broadening of the user base for digital assets. Particularly for us, we're focused very strongly on CFOs and finance departments and treasury departments. We would like to see them have access to the asset class and products underneath, so that they can start to develop some real world use cases and start to answer some of the questions that Rob, I think, very, very succinctly put in earlier in what he was saying. So for me, we're hoping that 2021 will be a year where if you modernize today, you can integrate tomorrow.
Very good. Thank you, Luke. Marco, your kind of takeaway, or what excites you most as we look forward?
I can share what the two prior commentators said, and I want to add that for me it's a natural shift into digital assets. So there is also the new generation coming up. There is an increasing understanding, and it's no more baby shoes, but we are in the kindergarten age in that regards. So now we just need to grow in a way that it's diligent, and we need to make our homework. So we need to change quite a lot of areas, but change in a positive way. And we are in a digital age, and new investment possibility might arise that we don't know yet today. So I'm really excited to see what is coming. And where I'm on in the commodity space, we did quite a big steps in the last 2 years to come up with something. So I'm eager to see also other areas. I think Adrian is in the real estate, so there is also kind of moving. Yeah, so I'm looking forward.
That's great, thank you. And then Adrian, coming to you, from a real estate perspective, I guess, what are you most excited about as we look to the future?
Yeah, I think for me it actually is for us as an industry not necessarily known for being the most forward-looking or digitized asset class. I think for me actually it's something quite simple, is actually for that to be common parlance by the end of the year. You know, tokenizing isn't some sort of abstract thing. It's actually just something that just becomes something that we're all familiar with. And I think, you know, writ large beyond just the real estate industry, I think for me, it's as and when the boards of asset management businesses and their service providers actually, when, you know, the language that we're using on this call becomes just normal. You know, I don't know about the audience, but I do have to concentrate quite hard when I hear people like Jack talk about this stuff, because it's still not quite my first language. But one thing's for sure, it needs to be. And that for me, I think, is really what 2021 is about. It's no longer some abstract thing. It's something that we're living and breathing and actually doing.
That's great. Thank you so much. And thanks to everybody for such an interesting discussion. We do have a couple of questions and a couple of minutes. So I may just fire through those before we wrap up. So there's a question here, Rob, for you. The question is, what are the risks of the USD or the US dollar tied cryptocurrency? So what guarantees its existence in the long term?
Yeah, I mean, quickly on stablecoins, you know, they are not all created equal. So I would say, you know, if that's a concern, do your research. There are some stablecoins where there's actually, you know, business or humans behind them, particularly a regulator, where you would say an issuer would take in fiat currency, that being US dollar in your example, and issue a stablecoin, and then the regulatory environment and specific regulators would say, as an example, you must keep that dollar, you can't do anything with it. You can't spend it for corporate purposes. You can't even investment in anything other than that which is super secure, such that you, the issuer, guaranteeing that you will be able to give that US dollar back. That is an extreme flavor of a USD denominated stablecoin. There is a continuum of different flavors. Those on the other end of the extreme saying, you know, there's maybe a basket of investments in the background and with a lighter level of regulatory scrutiny and hygiene required. So you know, it really comes down to do your research. They not all are created equal.
Great, thanks, Rob. Another interesting question here, and maybe Luke, I'll come to you first on it. Who do you think will win out in the digital asset custody space? Would it be the traditional global custodians or the emerging digital asset exchanges?
Yeah, it's a good question. I don't think there'll be a single winner. Is the sort of too long don't read, you know, version. And I think it's partly driven because custody is traditionally and is seen from a regulatory perspective and a product perspective as an ancillary service. So it is a secondary service amongst most regulatory permissions around safeguarding and administering of assets. A few observations, I think, for me around custody. A lot of custodians that have come that are new codes that have come through and new solutions being built have focused very, very heavily on the storage of the asset and the safeguarding of private keys. And to be quite frank with you, that was a problem that was solved 30 years ago. And so there's a lot of money that went into solving that particular problem. But certainly for us, we felt that the problem that needed solving was that that there was a lack of real financial controls on top of that service that allowed institutions to really orchestrate and manage complicated portfolio requirements that involve custody, whilst retaining a full audit trail. And that I think kind of got slightly overlooked in the melee. So I think who will win in the space, I think, will depend on what your as an institution your requirements are. I still see banks playing a very large role, and we'll see tier 1 banks moving into the space this year. So we'll be able to get some sense as to where the asset flows go in after that. But again, I would remind everybody that you are, if you're using a bank, you are still paying for their bank API to access a blockchain. And really, the point of all of this is that you can have direct access, and without wanting to sound too corny, you can be your own bank.
Perfect, thanks. I don't know if anyone else wants to weigh in on that question. If not, I've got one more for time. So the longer term impact of digital assets has really the potential to drive the transformation of infrastructure supporting the global financial system. We spoke about being on the journey, but where exactly do we think we are on that journey, and how many years might it take to see that transformation kind of come to life? Adrian, I might come to you for that question, but anyone else can feel free to weigh in also.
Sure. I think it's one of those ones where I'm going to try and avoid giving too prescriptive an answer. I'm sorry, by the way, excuse my kids, they've just clearly finished their homeschooling. It's that classic one where actually we're most likely to overestimate the short-term change, but hugely underestimate the longer term. And the reason why I'm just very careful even about expressing it in that way is that what we've learned with anything in the digital space, our definition of long term is not what we're used to in our normal lives. Long term in a digital environment is actually a handful of years. So I do think we could well be actually quite surprised about how quickly trust is actually built up in this way of working. And if we circle back to where we started all this conversation, the reason why digital assets has taken off is because people were losing faith in other forms of store of value. And so to the extent that there is still that concern and almost to some extent hedging one's bet, I think you can actually be surprised about just how much more that acceleration takes place. Coupled with that, as I said, coming back to a comment I made before, just where central banks are in all of this. It's great that we are seeing now the regulators really stepping up to the plate, but even that's quite a minor miracle compared with where we were just a handful of years ago. So I think it is just a handful of years, but it is still early-ish days because we're still talking about addressing quite fundamental things about creating a stable financial system, because that's really what we're doing. It's creating a stable financial system, and that cannot be created overnight. It took the stock market best part of 300 years. I'm pretty we can do it a damn sight quicker than that.
That's great, and I think that's a great kind of parting thought, I guess, Adrian. I know we're up on time, so we'll have to leave it there. But I want to say a big thank you to all of our panelists. Thanks very much for a real thought-provoking discussion. Some really great insights shared, and certainly food for thought. I'd like to thank our audience for your attention, for listening, and for putting up with my technical difficulties at the start. Much appreciated. We will be circulating some thought leadership articles around to those who've registered for some follow-up reading, so you can look forward to receiving that. And with that, we'll wrap it up there. Thank you, everybody, for joining.